Hello learners, welcome to the financial management video classes. Under the second module, the first class which deals with the investment decision. So let's start with the basics. So what is an investment decision? An investment decision is the process of allocating financial resources to assets or projects that are expected to generate returns in the future. So, in a business context, these decisions typically involve capital budgeting. That means evaluating large expenditures or long-term investments. Say for example, if any business wants to launch a new product, if they want to expand their business to new markets, or if the business wants to buy a new machinery, or if the business wants to acquire another company. So these decisions are strategic and sometimes often irreversible and involve future uncertainties. So that's why we need to be backed up by the robust analysis. Here there are two types of investment decisions. One is a long-term investment decisions, where we will discuss on the concepts like capital budgeting and these decisions that affect the company's operations and profitability over several years. The second type of the investment decision is a short-term investment decision, which deals with the concepts like working capital management. So these are the decisions related to managing the current assets and liabilities. So here in this today's video, we are discussing on long-term investment decisions. Let me ask a question. Why are investment decisions so important? So one thing is that these investment decisions determine the firm's long-term strategic direction and they affect the firm's profitability and shareholder value. Sometimes they involve large financial commitments, and if we make any mistakes, that is going to be costly to the organization. And they have the competitive advantage through capacity, technology and investment. Overall, in general, we can say that a smart investment today can secure a company's future tomorrow. What are the features of the investment decision? There are certain features. See, an investment is a planned decision, and there are certain factors which are responsible for these investment decisions. What are those factors? Like investment objective, because the purpose behind an investment determines whether the short-term or long-term fund allocation is required or not. This is the starting point of any decision making process, especially with relate to financial decision making process. Return on investment. Most of the times financial managers prioritize the positive returns. So they try to employ limited funds in a profitable asset or security. Even the tenure when it comes to the tenure also, the how often we receive the returns on the investment is also very crucial. Say for some companies they may get returns quarterly or semi-annually, for some companies maybe yearly, for some companies maybe monthly. It depends on the type of the business. And when we talk about the risk, you take any financial investment, it may possess high, medium or low risk. And the risk appetite of the every investor and company is different. So every investment requires a risk analysis. Tax benefit, because tax liability is associated with the particular asset or security. Another crucial deciding factor it is, because investors tend to avoid investment opportunities that are taxed heavily. An asset or a security offered by the company should adhere to the regulatory frameworks and has a transparent financial disclosure is considered as a safe. Most of the times government backed assets are considered the most secure. So your investment, the one of the principles of the investment, safety, liquidity, right? Volatility, because markets are dynamic in nature and market fluctuations significantly affect our investment returns. So we cannot overlook. The other side, liquidity, another important principle of the investments, because investors are often worried about their emergency funds, the provision to withdraw money before the maturity is there or not. So most of the times investors will be looking at the degree of the liquidity offered by the particular asset or a business. In financial management, most of the times investors look for investment opportunities where returns surpass the nation's inflation rate. So these are some of the factors or features of the investment decision. Now we'll moving to the very important element in the investment decision is the investment decision process. It is a systematic approach, if we observe, systematic approach to evaluate and select the best investment option. Suppose if we observe here on the screen, we have 6 key stages. The first stage where we are identifying the investment opportunity. Businesses constantly, they are scouting for new projects. They are launching new products, new apps, expanding from one place to another place, from one country to another country. They are spending on maybe due to the research and development, or because of the customer feedback, or with the help of the competitor analysis. They are trying to identify the investment opportunities. The second stage where we are screening, because not every idea is worth. So in this stage, the business has to filter out unfeasible or non-strategic ideas, if any, because the focus of the financial manager should be on strategic alignment, preliminary cost benefit analysis and risk considerations. The third stage talks about the real number crunching begins in this third stage, because we are assessing the projected cash flows, profitability and risks. And in this particular stage, sometimes we will be using the tools like net present value, internal rate of return, payback period, profitability analysis, sensitivity analysis, simulation analysis. We will be using, and say, for example, if a project with the high NPV is there, then definitely the project is attractive in nature. So in this particular stage, most of the times we believe the real numbers and we take the decisions. Decision makers, in the fourth stage, decision makers use both quantitative and qualitative factors to choose the best investment. Because how we are selecting the best alternative or project? Because already in the third stage you have detailed analysis you have done, but have you considered the qualitative factors to choose the best investment? So implementation, decision makers, after using both the quantitative and qualitative, they have chosen one best investment or alternative, and once approved, the company allocates the resources and sets the timeline, and execution requires coordination among finance, operations, human resource and marketing. The sixth stage, post-implementation review, is critical. Did the project met its targets? Was the return on investment is expected? Lessons learned from the successful or failed investments improved the future decision making? Because a structured investment process ensures better allocation of capital and higher shareholder value. So the sixth stage, we are not only reviewing, we are also evaluating whether our project is maximizing the value to the shareholders or not. So based on this concept, as a learner, as a financial manager, budding financial manager, how would you evaluate a proposal to expand a company into a new country? So if you have any thoughts, drop your thoughts in the comments. I'll try to understand. So how you are evaluating the proposal. So here we have in this video learned what actually is the investment decision. We have seen the factors influencing your investment decision and very critical concept, investment decision process. Thank you.